This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices higher this morning. Keep in mind that over the last 20 Tuesdays, the Dow Jones Industrial Averages have been up in every one of those days on a consecutive basis. So traders looking at that and in fact fully aware that that has happened over the last 20 days and seem to be anticipating that there could be a 21st day of the same. As far as the longer term view, the Fed continues to maintain their quantitative easing program, although every time we hear a Fed speaker, they either maintain the status quo or bring forward the possibility of a ramp down of the rate of asset purchases. So I think that is likely to be more and more of a factor as far as this bull market that we have seen in stock index futures. In fact, many analysts believe that the gains that we have seen, in fact, these are historic gains in stock index futures, are almost entirely due to the Fed's quantitative easing plan, which appears to be going away at the earliest at the end of this year, or more likely in the first half of next year. Over in the currencies, seeing the euro currency under a little pressure, we had Eurozone producer prices falling by 0.6%. That was against a guess of a 0.3% decline, the worst monthly report since July of 2009. Also, we are seeing the Australian dollar sharply lower. This after the Reserve Bank of Australia maintaining interest rates as they were at 2.75%. However, they did leave the door open for additional easings of credit. So that was the main reason for the pressure in the Australian dollar, almost 100 points lower at one point in the overnight trade. We continue to believe that the main trend for the Australian dollar and the Japanese yen is lower from an interest rate differential point of view. So we would expect lower prices for both of those currencies from current levels today and longer term. Over in the credit markets, futures under some pressure. Feeling is that if the Fed does slow down the asset purchase plan, of course that would in effect be somewhat of a tightening, or at least if they're less accommodative, some analysts believing that would be a tightening. We feel that that is the dominant influence right now. Also, we are seeing Treasury futures near 4-month lows, so we would look for some near-term pressure in the credit futures market. However, be very careful if there are any geopolitical situations that arise that could cause a flight to quality rally. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.